Gold goes from $1,800 to $2,000. That's an 11% gain. Your physical gold goes up 11%. But Barrick Gold stock, it could go up 30%, or it could fall 15% even though gold went up. Gold mining stocks are not the same as owning gold. They're leveraged bets on gold with their own set of risks that most investors completely miss. Today, we're breaking down the real relationship between mining stocks and physical gold, the leverage, the risks, and when each actually makes sense. Introduction. I'm Alex Morgan. This channel exists to help you understand investment mechanics before you put money at risk. Disclaimer, this is educational content, not investment advice. I'm not recommending any specific stocks or telling you what to buy. I'm explaining how these assets actually work. Here's what we're covering. First, why mining stocks move differently than gold itself. Second, the leverage effect that works both ways. Third, the operational risks you're taking on with miners. Fourth, real performance data comparing both. And finally, when miners make sense versus physical gold. Now let's start with the fundamental difference. Part 1. Why miners are not gold. When you own physical gold, you own a commodity. Its value is determined by supply, demand, and global monetary factors. When you own a gold mining stock, you own a company. Its value is determined by the price of gold, yes, but also operating costs, management quality, political risk, labor issues, environmental regulations, capital allocation, debt levels, production volume, reserve quality, and investor sentiment toward the stock market generally. This is critical. A gold mining company can fail even if gold prices are rising. It's happened many times. Example, in 2013, Barrick Gold stock fell 53%, even though gold only fell 28%. Why? Because Barrick had massive cost overruns at its Pascua-Lama project, took huge write-downs, and faced environmental violations. The company's problems overwhelmed the gold price movement. Another example, in 2020, gold rose 25%. Newmont Mining rose 42%. The leverage worked in investors' favor because costs stayed stable while gold prices surged, expanding profit margins dramatically. So miners amplify gold's moves, both up and down, and add company-specific risk on top. Part 2. The leverage effect. Here's the math behind mining stock leverage. Let's say a mining company produces gold at an all-in sustaining cost, AISC, of $200 per ounce, and gold is trading at $1,800. Profit per ounce, $600. Now, gold rises 10% to $1,980. New profit per ounce, $780. That's a 30% increase in profit per ounce, even though gold only rose 10%. This is operating leverage. When gold rises and costs stay relatively fixed, profit margins expand dramatically. The stock price should theoretically rise even more than profits because investors pay a multiple on earnings. If the stock trades at 15x earnings and earnings go up 30%, the stock could rise 30% or more. But the reverse is equally true. Gold falls 10% from $1,800 to $1,620. New profit per ounce, $420. That's a 30% drop in profit per ounce. If gold falls enough that the price approaches the cost of production, miners can become unprofitable entirely. The stock could fall 50%, 60%, even 80%. Historical example, 2011, gold at $1,900, Barrick Gold stock at $50. 2015, gold at $1,850, down 45%. Barrick Gold at $7, down 86%. The stock fell nearly twice as much as gold because at $1,050 gold, many mines became barely profitable, or actually unprofitable. This is the leverage sword cutting both ways. Part 3. Operational risks you're taking on. When you buy mining stocks, you're exposed to risks that don't exist with physical gold. Risk 1, rising costs. Mining costs have been rising for years. Labor costs increase. Energy costs fluctuate. Ore grades decline as easy deposits are exhausted. In 2020, average all-in sustaining costs were around $1,000 Oz. By 2023, they'd risen to $1,200 to $1,300 Oz for many miners. If gold stays flat but costs rise 20%, profit margins get crushed. Your stock falls even though gold didn't. Risk 2, political and regulatory risk. Mines operate in countries with varying political stability. Governments can raise royalties or taxes. Tanzania did this to Barrick in 2017. Nationalize assets. Venezuela, Bolivia have done this. Impose environmental restrictions that halt production, revoke permits or licenses. Mali, Burkina Faso, and other African nations have recently increased pressure on foreign mining companies. If you own that stock, you're exposed. Risk 3, operational failures. Mines collapse, equipment fails, labor strikes happen, environmental disasters occur. 2019. Vale's Brumadinho Dam disaster in Brazil killed 270 people. Vale stock fell 24% in days. The company faced billions in fines and lawsuits. If you owned Vale for gold exposure, you just lost a quarter of your investment due to operational failure having nothing to do with gold prices. Risk. 4. Management quality. Bad management can destroy shareholder value through poor capital allocation, overpaying for acquisitions, excessive debt failed development projects, executive compensation that enriches insiders. Barrick's Pascua-Lama project was budgeted at $3 billion costs, ballooned to $8+ billion before being suspended. Billions in shareholder value destroyed by bad execution. Risk. 5. Dilution. When miners need capital for expansion or to survive downturns, they often issue new shares. This dilutes existing shareholders. 2015-2016, during the gold price bottom, many miners issued shares at depressed prices just to survive. Existing shareholders got diluted massively. Risk. 6. Stock market correlation. Mining stocks trade on stock exchanges. During broad market sell-offs, 2008, March 2020, mining stocks often fall with the market, even if gold is rising. March 2020, gold fell 12% initially, but gold mining ETF GDX fell 41%. The stock market panic dragged miners down far more than gold itself. Physical gold doesn't have this correlation. It's a commodity, not a stock. Part 4. Real performance data. Let's look at actual returns over different time periods. 2000 to 2011, gold bull market. Gold, $4.63% from 280 to 577. GDX, mining ETF, forced through 18%. Wait, gold outperformed? Yes, because many miners had cost inflation issues and operational problems. The leverage didn't fully translate. 2011-2015 gold bear market. Gold, 45% from $1,900 to $150. GDX, 71%. Leverage worked in reverse. Miners got destroyed. 2016-2020 gold recovery. Gold plus 67% from $1,950 to $1,950. GDX, 187%. Here, the leverage worked positively. Costs stabilized, gold rose, margins expanded. 2020-2024 mixed period. Gold plus 135% from $750 to $2,265 peak. GDX, 15%, peaked in 2020, struggled since. Even with gold making new highs, miners underperformed due to cost inflation, operational issues, and market sentiment. The pattern: miners can outperform in strong gold trends with stable costs, but they dramatically underperform during gold declines and often underperform even when gold rises if cost or operational issues arise. Volatility comparison: gold average annual volatility. It's 15%. Gold mining stocks. Volatility are 30 to opportunity 40%. You're taking on roughly double the volatility for leverage that doesn't always materialize. Part 5. When each makes sense. Choose physical gold if you want pure exposure to gold prices with zero company risk. You're using gold as portfolio insurance or safe haven. You have low risk tolerance. You want to hold long-term 5+ years without worrying about company management. You believe in monetary system concerns and want direct ownership. You don't want stock market correlation. Choose gold mining stocks. If you have high risk tolerance and want leveraged exposure. You believe gold will rise substantially, 30% plus, and you want amplified gains. You're willing to research individual companies or use diversified ETFs. You want income. Many miners pay dividends. Gold pays nothing. You're comfortable with 30-40% volatility. You can actively monitor holdings and sell when company-specific risks emerge. Consider both if. You want core physical gold holdings, 60-70%, plus aggressive mining stock allocation, 30-40%. You're building a comprehensive precious metal strategy. You want dividend income from miners while maintaining physical gold insurance. The honest truth: most retail investors should stick with physical gold or gold ETFs, like GLD, if they want gold exposure. Mining stocks are for investors who understand they're buying companies, not just gold, can handle extreme volatility, have time to research or use diversified mining ETFs, are willing to actively manage positions. If you just want some gold in my portfolio for safety, physical or GLD makes way more sense than miners. Part 6. If you choose. Miners. If you decide mining stocks fit your strategy, here's how to reduce risk. Use diversified ETFs, not individual stocks. GDX, VanEck Gold Miners ETF. Large cap miners, GDXJ, junior miners. Smaller, higher risk. These spread risk across multiple companies instead of betting on one. Understand all-in sustaining costs AISC. This is the key metric. Miners with AISC under $1,000 SOS have more margin of safety than those at 300 plus SOS. If gold is $2,000 and a miner's AISC is $900, they have $100 OZ margin. Safe. If AISC is $1,400, they have $600 OZ margin. More vulnerable to gold price drops. Check debt levels. High debt during gold downturns can bankrupt miners. Look for balance sheet strength. Geographic diversification. Don't buy miners only operating in politically risky countries. Mix stable jurisdictions, Canada, Australia, US, with higher risk, higher reward locations. Watch management track record. CEO and management matter enormously. Look for disciplined capital allocators, not empire builders. Know when to sell. If gold looks like it's peaking, sell miners before the peak. They'll fall faster on the way down. If a company announces major operational problems, sell immediately. Don't hope it gets better. Conclusion. Here's the bottom line. Gold mining stocks are not a substitute for physical gold. They're leveraged, high-risk bets on gold prices that also carry company-specific operational, political, and management risks. When conditions are right, gold rising, costs stable, good management, miners can dramatically outperform physical gold, but they can also dramatically underperform or even go bankrupt while gold itself is rising. Historical data shows miners amplify both gains and losses, with volatility roughly double that of gold itself. For most investors wanting gold exposure as portfolio insurance or safe haven, physical gold or gold ETFs, GLD, make more sense. For aggressive investors with high risk tolerance who believe in a major gold bull market and can handle 40% swings, miners offer leveraged upside potential. The worst mistake, buying mining stocks thinking they are more the same as gold but better because of leverage, without understanding the additional risks. Match the asset to your actual goals and risk tolerance. That's how you avoid expensive lessons. If this breakdown helped you understand the difference, hit the like button. Subscribe for more investment reality checks. Drop a comment. Do you own miners, physical gold, or both? What's been your experience? Thanks for watching. Stay informed, stay realistic, and I'll see you in the next one.